Okay, let's talk about this extra supplemental document that I uploaded for you guys in regards to chapters 7 and 8. This is really good practice as well as your homework for this particular chapter. Let's go through them real quick and I'll give you the answers. Number 1, safeguarding of assets is definitely one of our objectives for internal controls for a company. So that would be true. Number 2, the responsibility for keeping the records, the documentation, the access to the accounting information system where journal entries are made for a particular asset should definitely be kept separate from the physical custody of the asset if and when at all possible. So larger companies are easily able to do this, but smaller companies may have a harder time with it. But again, this item is true. We're talking about the fact that responsibility for the different areas, so keeping the records, debiting and crediting those journals, etc., is a separate responsibility from actually keeping the asset within custody. For example, someone in a warehouse is watching over that inventory and taking things off the shelf and putting items back on the shelf. We need separation of duties. So we don't want Joe able to actually debit and credit inventory at the same time Joe is able to take items off the shelf and put items back on the shelf. We want the responsibility established for the different duties, but we would really want those to be two separate individuals. So understand that separation of duties is different than establishing responsibility. Go back and make sure you understand that. Again, we want to consider the things that we've learned about internal controls. We want to consider the things about the fraud triangle. If any way that we can eliminate opportunity, that we need to do so. Number 3, bonding means ensuring a company against theft by employees. True. Number 4, a good system of internal control will safeguard its assets and enhance the accuracy and reliability of its accounting records. True. Number 5, the responsibility for ordering, receiving, and paying for merchandise should be assigned or delegated to different individuals. True. We do not want one person having responsibility for each of those items. We really want them separated out. So we do not want one person to have responsibility for all 3 of those. Number 6, the separation of duties feature of internal control can be negated when several employees are involved in a scheme. True. This is called collusion. So they may find ways of circumventing the controls related to their particular item of responsibility and how that it relates to other individuals' items of responsibility, and therefore work their way past the separation of duties. Number 7, which of the following bank reconciliation items would not result in an adjusting entry? When you get a question that says not, I advise that you guys circle or underline the not and think of which ones do result in an adjusting entry, and the one that does not shall stand out to you. So when we think about those items on that bank reconciliation, specifically that one PowerPoint slide that I told you needed to print that out to make sure you understand it coming and going, in regards to a service charge that a bank would be charging the customer and withdrawing that money out of their account prior to sending that bank statement in the mail, would require an adjusting entry on the book side. Deposits in transit, however, does not need an adjusting entry. Why is that? Because on the book side, the company has already added those deposits in, so they already know about them. So an adjusting entry is not necessary on the book side. There's no debits and credits that need to be done for B. So that is our answer, but let's continue talking about our other choices. An NSF check of a customer is an insufficient funds check that has been deposited whenever it was received by the customer or from the customer, but then the bank took the money back out when they received word from the issuing bank that the original person who wrote that check did not have enough funds in their account to cover it. Okay, so the company would have to make a journal entry, and they would have to remove that money out of their checking account balance. What would they do? They would debit back the accounts receivable of that customer to show that that customer does in fact owe that money again, and then credit cash to take the money out of the account since the bank took the money out of the account. D, collection of a note by the bank. That's basically stating that the bank has received money on behalf of the client or the customer, the company, and deposited it into that bank account. Therefore, an adjusting entry would be necessary to increase the amount of cash that the company shows. So they would debit cash to increase cash and credit a note receivable most likely. Number 8. If you haven't gotten used to doing one of these yet by doing your homework, let's talk about it real quickly, but I want you to kind of write down some things while I've got this up here. Alright, so here we've got James Company had checks outstanding totaling $21,600 on its June bank rec. In July, it issued another $155,600. The bank statement shows that $105,200 cleared or were deducted in July. Also, a check from one of James's company's customers in the amount of $1,200 was also returned marked NSF. The amount of outstanding checks on James's company's July bank reconciliation should be what? Alright, let's do the math here, and I'm going to scroll up so we can keep our scenario at the same time we've got our calculator up. We literally would take the amount of what was outstanding for June, which is $21,600. We would add that to the amount written in the month of July, $155,600. to give us a total of $177,200 outstanding plus written between June and July, and then we would subtract out what they said actually cleared during July to give us a remaining $72,000, which is B, in outstanding checks. The NSF check is not considered an outstanding check. It is considered an item that gets immediately withdrawn, and it requires an adjusting entry on the company's books. Make sure you understand what's going on here and how to calculate this number. Next, we've got one. Again, I'm going to move this calculator over, move this up. Carlin Company gathered the following reconciling information in preparing its April bank rec. I'm going to jump right down to the bottom and skip the TMI information for now and read what it's wanting us to calculate. The adjusted cash balance per books on April 30th is what? Again, get out that PowerPoint slide and go through the process. We've got $13,200 as our cash balance per books prior to any adjustments. We need to add to it the note receivable and interest that was collected on their behalf by the bank, so plus $44.40. And we need to deduct $150 that the bank charged for printing. And we need to deduct the NSF check of $840. Therefore, our adjusted cash balance per books on April 30th is $16,650, which is C. We did not use the TMI, deposits in transit number. Okay, think of the fact that this $1,800 is for known deposits made by the company. Therefore, this $1,800 would have been included in how this $13,200 number came to be. Same thing here for outstanding checks. The company knows that it wrote these checks. It would have already subtracted out this $9,000 in also coming to this $13,200 amount cash balance per books. Now we would use these on the bank side of calculating out the balance, which should also equal $16,650, because this is our adjusted cash balance per books, which should also match our adjusted cash balance per bank. The next question here is what I'm going to refer to as a challenge question. As long as many of my accounting students can work their way through this, is where this really applies to you. I'm going to run through how you can go about calculating it. Here they're telling us our cash balance per bank as of 12/31 is $20,000, and then they're giving us some additional information. The notes receivable collected by the bank of $10,000, of course, is included in this $20,000. The outstanding checks of $15,000, however, will be subtracted from this amount later whenever they actually are presented to the bank for payment. Deposits in transit, $7,500, are not included in this $20,000, but they will show up later and be credited in the next month, the month of January. The bank service charge of $125 has already been deducted in formulating this $20,000. And this NSF check of $2,000 has also been deducted prior to coming up with this $20,000 amount. Therefore, how can we go about determining the cash balance per books before any adjustments have been made? We can literally take the $20,000 and subtract out the $15,000 in outstanding checks. We would add to it the $7,500 in deposit in transit. We would add to it the $21.25 that's being deducted by the bank, because the deductions the bank took to get to the $20,000 the company does not know of yet. So we're going to add them to our number. And then we would subtract the $10,000 for the notes receivable that was collected, because the bank made the addition to the $20,000 to get to that $20,000, but the company does not know about it yet. So we're literally doing the opposite of two items, whether the bank deducted some money or added some money that the company did not know about yet. So our correct answer would be $4,625, which is A. Alright, number 11. This is another make darn sure you all understand how to do this. A $200 petty cash fund has a cash amount in it, included in cash and coins, of $37 even, and receipts of 160. The journal entry to replenish the account would include what? All right, I want to go through this one for you step by step to make sure you understand all aspects of this. If our account is established at $200 and we only have $37 in cash in the box, we will subtract the 37 from 200 to let us know that we will be writing a check for $163. It will be cashed into cash and coins, and the $163 will be placed back in that box so that the box will be back to an even $200 that it was established at. Okay, knowing that we are going to write the check for $163 means that one part of our journal entry will include a credit to cash, because that is where the check is going to come out of. Not petty cash, but cash. All right, so credit to cash, 163 is one part of what we would do here. So write this down on your copy of this document. Now, we have receipts totaling $160. Therefore, we are going to debit a couple of different expense accounts and possibly even an asset account, supplies, for the items that we purchased or used money for that those receipts substantiate. Okay, but notice those debits to expenses or possibly one asset, supplies, would only equal 160, and our credit to cash when writing the check is 163. Recall that debits must equal credits. Based on that, we are going to have one additional line item for $3 with a debit to the account we've learned in our 2 chapters, cash over and short. And this is where those overages and shortages are going to show up. Therefore, our correct answer on 11 is C. Okay, so we're going to have debit to some expenses and possibly an asset, supplies, totaling 160 for the amount of receipts. We are going to have a debit to cash over and short for $3 and a credit to cash for 163. Now let's look at the next one. Same type of scenario, different information. A $100 petty cash fund has cash of $16 and receipts of $86. $100 is what it is established at, minus the $16 in cash means we will write a check and replenish that box of money with $84. Therefore, it's going to be a credit to cash for $84 is one part of our entry. Our receipts are substantiated by $86 in receipts. So debit to expenses and possibly one asset account, supplies, for a total of $86 in debits. Again, debits must equal credits. We've got 86 here and 84 there. Therefore, we're going to have a $2 credit to match up with this 84. And that's going to be to cash over and short for $2. C. Okay, make sure you've got that down pat. Number 13, trade receivables can be accounts receivable or notes receivable. This is true, depending on how you sell your items and substantiate your credit with your customers. 14, both accounts receivable and notes receivable represent claims that are expected to be collected in cash. True. a debit balance in the allowance for doubtful accounts. Okay, this brings me to mention our supplemental document that I loaded on your behalf regarding Chapter 8. You need to be 195% positive that you understand every element included in that 4-page document. If you have any questions whatsoever, you need to either load them on our Blackboard as a discussion item or send me a very specific email stating what you do not understand. Again, Chapter 7 and 8, Test 4 is typically the lowest grade, so you guys really need to buckle down on these two, do all the homework, watch the video lectures over and over again, review the supplemental documents that I've uploaded. Also, making use of your learning objectives and glossaries for Chapter 7 and 8, as well as the ICPs for 7 and 8. I cannot stress that practice makes perfect, so make sure you understand the lingo and the entries that are required, etc. Alright, so number 15. A debit balance in the allowance for doubtful accounts means that B, it indicates that actual bad debt write-offs have exceeded previous provisions for bad debts. Okay, so allowance for doubtful accounts method, under the allowance method, management makes an estimation of what they think will not be received in, and they make a one-time adjusting entry when they're closing out a period. They will debit bad debt expense and credit allowance for doubtful accounts. Therefore, if the allowance for doubtful accounts during the next period ends up getting debited so many times that the balance in the account ends up showing a debit, then that means over this most recent period they have had to go and make those entries that are required when a customer actually is deemed uncollectible under the allowance method. They will debit allowance for doubtful accounts and credit accounts receivable. And after you've done that so many times, you possibly can have a debit balance, and it will have to have additional amount in the closing entry in order to not only take it back to zero, from the debit balance to zero, but from zero on to the new estimated allowance for doubtful accounts amount, because allowance for doubtful accounts is our contra accounts receivable account. Number 16, under the allowance method, bad debt expense is recorded for an amount that the company estimates it will not collect. So only when that adjusting entry is being made is bad debt expense debited for the allowance method. Okay, so that's a one-time deal, but each individual customer that's written off, the debit goes to the allowance for doubtful accounts account, and the credit goes to accounts receivable. So again, make sure you understand these questions, but also the items contained within that supplemental document. Number 17, when the allowance method is used to account for uncollectible accounts, bad debt expense is debited when C, management estimates the amount of uncollectibles. Whether they're using the percentage of receivables method or some other way of calculating out on a big picture scale what they think will not be collected, it's done one time, and it's done as an adjusting entry at the end of the period so that the balance sheet is shown to the best of the company's reporting abilities. Number 18, an aging of a company's accounts receivable indicates that $4,500 are estimated to be uncollectible. Okay, $4,500 is the estimate, then $4,500 is what needs to show on the balance sheet. If using that unadjusted trial balance, the allowance for doubtful accounts shows a $1,600 debit balance, then an adjusting entry is necessary. The adjustment to record bad debts for the period will require, again, think of a number line, and you have to get it from 1,600 on the left-hand side to 0, so 1,600, and then you've got to move it all the way to 4,500 credit, so you're going to add that to the 1,600. Okay, so it is going to be a one-time adjusting entry, debit to bad debt expense, that will show up on the income statement, 6,100, and a credit to allowance for doubtful accounts, also of 6,100, and that final amount that will show on the balance sheet for allowance for doubtful accounts will be 4,500. If you don't understand this, you've got to get with me. Number 19, an aging of a company's accounts receivable indicates that 4,500 again are estimated to be uncollectible. If, however, the allowance for doubtful accounts has a 1,600 credit balance, again, an adjustment is necessary because we have to get the allowance for doubtful accounts to show at 4,500. It's our contra accounts receivable. Okay, so if accounts receivable is an asset, it has a debit balance, then allowance for doubtful accounts will have a credit balance. So it's supposed to show up at $4,500 credit. Thankfully, it's at 1,600, so we only have to go from 1,600 to 4,500. Therefore, we can take 4,500 and subtract 1,600. Therefore, we know we've only got to move it 2,900. Therefore, it's going to be a one-time adjusting entry, debit to bad debt expense, 2,900, credit to allowance for doubtful accounts, also 2,900. 20, last one, a major advantage of national credit cards to retailers is that there is no charge to the retailer by the credit card company for their services. False. Definitely between 2 and 4% of the total amount charged on the credit card each sales transaction, and this even includes the amount of sales tax that retailers collect for the State Department of Revenues. So this can be a very costly line item, 2 to 4% of total amounts charged to credit cards for those companies, which of course can be a heavy expense for small businesses, sole proprietors, etc. All right, study hard, guys. See you tomorrow.